Right. This pattern is called an expanded flat. It's a three-wave decline labeled ABC, where wave B rises to a new high above the start of wave A until it finally gets, crashes down in wave C. And for the technicians in the audience, wave A needs to be three waves, wave B three waves, and wave C needs to be five waves, in this case, five waves down. 1, 2, 3, 4, 5. And now let's apply that to commodities. Here is on the top the Bloomberg Commodity Index. Actually, before we do the actual application of the analysis, let me give you some background to my thesis here. Again, back in early 2020, February 2020, during the coronavirus crash, remember that one, I was looking at this pattern that I'm about to explain, the expanded flat correction in the Bloomberg Commodity Index, and using that, I was able to identify that the index is likely to continue falling to the 60 to 64 range. And the actual low, which occurred a few months later, was at 58.87. Again, it's not pinpoint accuracy, but this analysis and this methodology, Elliott Waves, gives you the ability to target within a general range sometimes, and even a tradable range to identify opportunities. And, we continue falling right here. I waited a few months or several months, but by September, the target was reached. I said target reached, bear market over. And since then, you can see that we've had, a great move up in commodities. Let me also point out that the sideways correction in the Bloomberg Commodity Index lasted 40 years. And during that entire period, you had U.S. 10-year bond yields also declining in a disinflationary trend. But toward the end of that, here in September, at the same time that I'm saying that the bear market is that in the commodity index is over, I'm also saying forecasting enormous upside for commodities, price inflation, and interest rates in coming decades. Why? Because you can see over time that these two markets, two asset classes have trended together with each other. And, so I figured, okay, we're going to have a bull market in interest rates as well. Now let's go to the analysis. Why was I so bullish back in 2020? Why did I believe that the commodity bear market had ended? And that's shown right here. You can see the Bloomberg Commodity Index from 1962 traced out a five-wave advance, right, to the 1980 high, which I believe to be, or in this case, Roman numeral wave 1, up of a much larger pattern, right? Roman numeral wave 2 was the expanded flat correction. Wave A down is three waves, wave B up is three waves, and wave C down, right, is 1, 2, 3, 4, 5 waves down to complete this Roman numeral wave 2, which we call cycle degree. And again, during this entire period, U.S. 10-year bond yield had declined to the 2020 low. But and over, if you're forecasting a large third wave like I am here, this Roman numeral wave 3 up, which I think has already begun and it is in its early stages, you're probably going to get a very large move up in interest rates as well. And again, the 1970s, the period of the 1960s and 1970s shows that wasn't, these two asset classes did not move in lockstep with each other, right? But by the end of the period, you say, okay, yeah, there must have been some relationship, that it's kind of obvious. And it's interesting that the commodity bull market here, this wave B advance, did not result in a corresponding move up in interest rates, but I think that's because the entire correction needed to end first. And so anyway, all of that evidence points to a super cycle advance in commodities and interest rates. And now let's get to another feature of this. Again, we were talking about the Sensex fractal, right, in Indian stocks, how the larger degree second wave was similar in form to, there it is, the smaller degree, right? This previous second wave right here, we've got an ABC correction that is basically similar in form to this larger second wave. And this is just like the India fractal gave me confidence to be very, very bullish about a third wave going forward. This is the same pattern playing out here in the commodity index. And what it implies is a massive third wave advance that's going to last decades. And here's the evidence for that. You can see basically in blue on the left, you can see wave 2 is a fractal iteration, a copy of wave 2 of 1 down here. That's the language we use at EWI. But look at this UR here, right? This is the approximate juncture that you're at. If this is the wave 2 here and this is the wave 2 here, well, we have at this 100 level on the index, we're approximately down here, the equivalent level in this wave 3 advance, this large wave 3 advance. And it took 5 years to get from the 2020 low to where we are now, right? And if that 5 years is what this took, to get to this comparable location on within this wave 3, well, then how many years is it going to take to get all the way to the end of wave 3 if this is the comparable wave 3 over there, right? You've got an 8-fold multiple. 5 years here. It took 40 years to complete what took 5 years over here. That's an 8-fold multiple there. I wouldn't be surprised if we also have another, 8 or several-fold multiple in order to get, and that implies several times the 5 years that we've done. So that's why I'm saying that we've got a bull market in commodities and probably interest rates that's going to last at least a few decades.